Hi, I'm Mike, Chief Investment Officer here at Lighthouse Financial, and I've got another market update for you. March 2025, I'd like to cover the following talking points with you. So we'll size up the markets like we always do. Not a surprise to you, probably we're in correction mode, and this is the correction that we needed to reset valuations, but this is not the one we wanted, and I'll tell you why. A lot of uncertainty and policy error risk, some of which we hinted at in our last video, but it's really starting to hurt public opinion. Consumer, business leader, investor sentiment is deteriorating. So we'll talk about that in detail. Rates and inflation, this isn't nearly as important at the moment than policy uncertainty with the Trump administration, but we will talk about the Federal Reserve and interest rate policy there. And I'll say just at the outset that the Fed is really looking at inflation, and inflation is at the mercy of trade tariffs, it seems like, or at least that's the market narrative. The economy, finally, we'll talk about hard data versus soft data and what that means. Shorthand, the soft data is the surveys that are showing us that sentiment is, or the mood is souring, not just on Wall Street, but on Main Street. And that's a real contrast to the hard data, which show that the economy is still pretty strong. And of course, corporate earnings are always in the top of mind for us, because if you are an investor in the U.S. stock market, what you really care about most is can publicly traded corporations, continue to drive revenue growth and profit growth. That's really the most important thing. Okay, so yes, we're in correction territory. What does that mean? So the U.S. stock market, going back in time, usually experiences 10% correction about every year or so. And this chart's for the last couple of years. You can see that coming out of the 2022 bear market bottom, we did have a 10% correction in 2023. We didn't quite have one last year, but we're getting it now. So what I want you to notice about this chart is that nothing here is abnormal, nothing. 10% corrections happen all the time. And in fact, maybe you remember this, maybe you don't. Back in 2022, the stock market went down 27% in the first, 10 months of the year. And I'll refer to that again in a moment, but nothing terribly out of the ordinary as of yet. Now, if you look at the NASDAQ, which is more tech heavy, it's a basket of stocks that are more tech heavy, that's down more. And also, if you look at the Magnificent Seven, which are the high flyers that have been doing so well in the stock market during 2023 and 24, they are going down more, obviously. This is a year-to-date chart. The Magnificent Seven, those are stocks like, NVIDIA and Tesla and Microsoft and Apple and Amazon and Google, those more tech-oriented names. Anyway, they're down 13% year-to-date. And many of those names I just mentioned are down 20% or more from their recent highs. The blue line here is the other 493 stocks that make up the 500, the S&P 500 index. And those other 493 are generally faring better. In other words, they're not coming down as much. And that absolutely makes sense, because part of the reason that you have a correction every once in a while is to reset valuations. Hype or expectations for the future. Sometimes they sort of push stocks up too much too quickly, and maybe the reality doesn't pan out, and so you get correction. So that's what we're seeing here. This is a chart that shows the valuation of those Mag 7 stocks versus the other 493. The chart shows technically price to earnings ratio, which is a way that we assess and describe how cheap or expensive the market is. I'll just show you the green line. You see how it peaks up 3 times there at a very high level and falls off each time. Well, that should tell you that whenever the PE ratio gets that high for this Mag 7 group, it's going to fall off. In other words, they got too expensive. They ran ahead of reality. So they're falling more. Their PE ratios are falling more. But the last thing I want to point out about this chart is that, and we all know this intuitively, when the stock market goes down or when individual stock goes down, if it's a quality company and there's nothing permanently wrong with it, you're going to get a recovery, because the cheaper it gets, the more attractive it gets to investors who look at these PE ratios every week. Okay, on the other side of the stock market's the bond market. The bond market struggled. Yes, it's true that interest rates reset by the end of 2022, really to much higher levels, and making bonds more attractive investments. But gosh, there's been a lot of volatility in interest rates, volatility in the bond market. It's really made it hard for bond funds to make money. And so the black line here is a Vanguard bond fund, a very widely held one, intermediate treasury bonds. And what I want you to notice here is that as the stock market began to fall in mid-February, culminating in what we now see as a 10% correction, that black line started to move upward. So treasury bonds have been appreciating, treasury bond funds have been appreciating, and treasury bonds. And gold too. Gold been on a tear for several different reasons, but also picking up value here is partly as a safe haven trade. This is absolutely normal. When you get rough patch in the stock market, it's not uncommon for traders to take part of their funds and shift a little bit more toward the bond market, where there's less volatility for a time. Okay, so what's the reason for this shift and the correction? It's really this: the mood on Main Street and Wall Street is souring. Sentiment surveys, or what I call the soft data, are coming in lower and lower. The bottom line, there, blue line, is a survey that they do weekly of individual investors, and they ask them very specifically, are you bullish in the stock market over the next 6 months? And then so what you'll notice, that if you can see this, the number there at the end of that chart is 19%. So only 19% of individual investors at the moment are bullish. That is an exceedingly low number. In fact, you got to go back to the middle of the 2022 bear market to find a number this low. Moving up is the orange line, or consumer sentiment. University of Michigan runs a survey of consumers, asking them, how do you feel about your finances, the economy going forward, near term, near future, and those numbers are falling off as well. And then finally, the top line is small business optimism. NFIB runs this survey, National Federation of Independent Businesses. These are small businesses. You can see an uptick right around the election because President Trump was assumed to be the more business-friendly candidate coming into the election. But since then, that started to fall off a bit as well. This is the most important cause of the correction that we're in, is mood or sentiment. And one of the things that we mentioned in our last video as a lesson for 2025 is don't react too quickly to sentiment changes because they can undo themselves quickly. We'll mention that again in a moment. All right, so this is why, right? You see these headlines, and they range from the ridiculous, like President Trump calling Canada the 51st state, to maybe the more sober, which is the Treasury Secretary there in the middle right, saying that he believes the economy needs a detox period, and what they're trying to do is shift the economy from a more public spending oriented economy to more of a private spending economy, where it was before COVID. Right, we all know that federal budget deficits in the wake of COVID have exploded, and they're not getting any better. So his point was, it may take time and it may cause volatility in capital markets, but this is the transition that we need to accomplish. How much of this is real, and how much of it is a head fake or a negotiating tactic, pick your phrase, we don't know. And that's the uncertainty. Anyone who tells you they know what's going to happen is lying or deluded. This is a very uncertain environment. And when you're in a more uncertain environment, you get this, you get a correction. The stock market, it will not be manipulated by politics. It is simply a voting machine, and it will tell you when the risk level is rising and when the risk level is falling. And right now, it is rising. It doesn't mean that the worst case scenario will come true. In fact, plenty of these headlines love to talk about worst case scenario. Mark Lasry, highlighted by the black there, Mark Lasry says the economy can't survive under Trump uncertainty. So these sort of these phrases that are full of hyperbole make their way into headlines and lead people to believe that the worst case scenario is inevitable. That is absolutely not the case. All right, let's take a step back from fiscal policy uncertainty and talk about the Federal Reserve for a moment. They're nowhere to be found in the market narrative right now. Nobody wants to talk about them. The Fed was the preoccupation of investors coming out of the housing crisis and ever since, right? What's the Fed going to do? Because they kind of control interest rates to an extent. So what are they going to do with interest rates? And now they're sort of in the background looking with wide eyes at this whole situation, just like you and I are, and they don't know any more than we do about what's going to happen with trade tariffs. So, the Fed's in this interesting position where they've been trying to lower interest rates, having successfully knocked inflation down from 9% all the way down to 3%. Kind of felt like they should do a victory lap, and they did. You can see with the orange line here is the level of the interest rate they set. It stepped down, right, in the last part of 2024. But now they're on hold, and they're not doing anything with rates because they're wondering, will the tariffs, if they are imposed in their fullest extent, are they going to be inflationary? And that's sort of what investors are thinking, that tariffs are generally speaking inflationary. In my mind, the devil's in the details. Not all of them are likely to come to fruition. In fact, maybe most of them won't. But again, uncertainty. So the Fed is a little bit afraid to lower interest rates, wondering if inflation is about to reaccelerate. Now, the blue line here on this chart, as you remember, the blue line, it doesn't have anything to do with federal officials or Federal Reserve officials setting rates. It has everything to do with traders in the market trading with their expectations of what's going to happen down the road. And you can see that blue line fall off at the end. That blue line falling off at the end is telling everyone, hey, we think growth is going to slow a little bit, and Fed funds interest rate probably should be lower. For the 2-year Treasury note yield, it's already lower. So this is traders kind of moving ahead, signaling this is what should happen. Will the Fed lower interest rates? I believe they will continue sometime this year, but we're just not sure, and they're not sure, I don't think either. So, oh, and by the way, let me go back for a second. They could be the white knight that helps us out. Already interest rates with this mini crisis or this correction we've had, already mortgage rates have come down to something like 6.7%. And if the Fed lowers interest rates further, mortgage rates will come down further. Auto loan rates will come down further. It acts as kind of a stimulant to the economy. So they could be sort of a white knight riding in and sort of saving the day, but we're not sure if they'll choose that. Okay. I said one of the things that's holding them up is inflation, right? They haven't made it. They haven't gotten inflation down to their long run target in the red there at 2%. Pretty close though, roughly 3%. And I think that, we've been obsessing about the fact that inflation over the fall kind of reaccelerated just a little bit, or maybe eggs for a while, inflation in eggs. Auto insurance is still a headache, right? That's still high inflation. But for the most part, I think we are still in a downward sort of sloping environment for inflation. And in fact, our latest CPI or Consumer Price Index reading showed that. So it decelerated to 2.8%. I think you will get inflation coming down. But again, trade tariffs, if they're imposed and to what extent, that could have an impact. because tariffs are generally thought of as being inflationary. Okay, we've talked about the soft data, which is the survey data, and that chart was a downer, right? That was very sad. We need to talk about the hard data because you can't make investment decisions based on emotion or political sentiment. You've got to base it on fact. So I've chosen a few slides to show you not opinion, but dollars, what is actually happening, dollars and paperwork. Okay, so paperwork first. This chart is a number of new claims for unemployment insurance, theoretically for people who've been fired or laid off, right? And these are first time, and they're measured on a weekly basis, and this chart is going nowhere. It has not spiked, and every time we get to a point where it looks like it's uptrending, like the middle of 2023, you get these voices of, oh no, here it comes. This is the major, layoff wave. We're all in for it. Hasn't happened yet. This is a chart, by the way. It's not just me that watches this. Everybody in the investment community watches this because it's what they call high frequency data. In other words, it comes out every week. So you have a pretty up-to-date look at what's going on. Okay, next one is a chart that shows two things. On the top line, the white line, is the number of unfilled job positions in the US. And the bottom in the blue is the level of layoffs, number of layoffs. Okay, so job openings or jobs open, currently open. That's you see that chart's come down quite a bit since the middle of 2022. That's normal, right? So we're 7.7 million unfilled jobs right now. That's still higher than the historical average, looking back, pre-pandemic when everything got so distorted. So 7.7 million. And by the way, that's about the same number, a little higher, as the number of people who are unemployed in the US. So I look at this chart and I say, well, we have about one job opening for everyone looking for a job. That's not bad, okay? And maybe 1.1 jobs. And then on the bottom, I see that the level of layoffs is not spiking as of the end of January. Some of this data is a little farther back looking, but anyway. So we're not seeing a spike in layoffs yet. That could come, but we just don't know yet. The hard data is not showing that. Next, just looking at spending habits. So the blue line is consumer spending year over year. And you can see this is growing at a 5.6% year over year rate. Now, of course, your spending is going to increase if inflation increases, right? Because you're buying the same things theoretically from year to year. So let's say this is 5.5%, and inflation is going to be 3%. So you still have 2.5% of spending growth above inflation. That's pretty healthy. And you could actually see this chart trend a little lower and still be healthy, considering what's happened in the past. The black line is average hourly earnings, AHE, or wage growth year over year. And I look at it this way. If wages are growing faster than inflation, so wages are growing at 4%, inflation's growing at 3%, then that means the US consumer, as long as the job market holds together, and it is so far, US consumers making more money than inflation is growing, then they're going to spend it. So that's kind of feeding consumer spending. So far, this chart looks really healthy. We are watching the fact, that these DOGE federal worker cuts, which have varying degrees of success, to the extent that judges don't say, no, you cancel all that, you can't do it. There are going to be some layoffs or some buyouts, early retirements, and so forth. And I was reading Barron's a week ago, and they said they think the maximum could end up being somewhere around 300,000. So that should show up in the data at some point. It is not showing up yet, and it makes me think that look, with 7.7 million open job positions, it may not be all that hard for federal workers to find another job. But we'll see in coming weeks. I need to point this out to you because sometimes the data we look at gets so distorted, you have to overlook it. Okay, so this is a chart showing in the red US import growth degree to which we're importing stuff from other countries in the red, and then versus US export growth in the black. And you see really uncharacteristic large move here at the end of that chart early this year in imports. And that's because business owners, purchasing managers are trying to get ahead of these tariffs, and they just ordering all kinds of things from overseas to stock their inventories ahead of this, the tariffs, which are essentially a tax or make their cost of business or their raw materials more expensive. So that's what they're doing. Well, what did that do? It ended up pushing the US trade deficit for the first quarter up by quite a bit. So when we have a higher trade deficit with our trading partners, that feeds into the economic growth equation. So the first quarter US economic growth, or what they call gross domestic product, anyway, it could be negative. We might have negative growth for the first quarter, all based on this distortion. So we are mindful of that, and that's why we don't just look at one or two charts. What matters in the end is this a one-time event? Just like tariffs. Are the tariffs a one-time event that cause a one-time issue and then we can return to normal, or are they more of a long-term strategy by the Trump administration to gain concessions from our trading partners? We don't know. So I told you we'd mention corporate earnings, really, really important. One of the prime things that we look at. So this chart shows the S&P 500 index, which is a basket of the 500 largest companies traded in the US stock market. Okay, so the black line is a survey of all Wall Street analysts who follow these things. What do they think profits are going to be for these 500 companies? And they add them all together, right? What do they think profits are going to be over the next 12 months? So yeah, there's guesswork over the next year. If you look at this chart back in 2022, those expectations started going down. That black line really went down hard because inflation was so high. The Federal Reserve had to raise interest rates. Everyone felt like that's going to be a real tax on growth. The economy can't continue to grow at the rate it has, and corporations are going to be suffering in terms of their profit growth. So that's why that black line went down. It has since recovered. And what I want to show you is that up at the right-hand edge of this chart, earnings expectations are not falling. Yes, I know the mood is soured. We know that there's risk in these tariffs and the DOGE cuts. We're not quite sure what that risk is, so the market's shooting first and asking questions later. But at the moment, we're really not seeing much of a fall off at all in earnings expectations or profit expectations for companies. The same with this orange line, which is the projected operating profit margin combined for all 500 companies. And not only is it not falling off, but I'd like to point out that we are at all-time highs for profit margin. One of the reasons for that is AI investment. And the idea here is that it's not just AI, it's also automation. There are forces at work in corporate America that are making business processes more efficient. And so that's why we're seeing corporate profit margins at all-time high. So we'll watch this chart. It's updated from time to time. And so far, we don't see any of the negative here yet. So I showed you this chart last time. Opportunities on the left and risks on the right. Okay, so let's start on the right with the risks. So at the beginning of the year, we identified 4 risks. 2 of them have already come to pass, and I must say we didn't expect it to come this quickly. But valuation reset for stocks. Okay, so I think everyone sort of figured, hey, you had 2 years. Let me back up here. I'll show you. We had 2 years in the stock market where you got 20% plus returns. At some point, there's got to be a little overshoot. At some point, there's got to be a correction, right? So we felt like, not only that, but the idea behind the mag stocks getting too expensive. There's the PE ratios again. Mag stocks dominating the market, accounting for most of the returns of the stock market, and then their PE ratios or their expensive quotient, however you want to put that, just got too high. So we felt like, you know, we're due for a valuation reset. Well, we're getting it. And look, the overall stock market may be down by 10%, but a lot of these Mag 7 names, a lot of the big tech companies that you know as household names are down 15 to 20% more or plus. So I think we're already getting that valuation reset for stocks. I don't think we're all the way done with it. We're more than halfway, is my guess. And then the third risk that we list here is the growth scare to do a trade war. Now, the problem with this is, again, the uncertainty. So, you know, business leaders, investors, consumers don't know how to plan for this because they're not quite sure how much of it is real and how much of it isn't. So, so it's a growth scare, meaning that it's going to ding growth, economic growth, profit growth for companies. So we're just not sure how much. And so you see the opportunities on the right-hand side. We really thought at the beginning of the year, the earnings growth was going to accelerate close to what Wall Street was saying, which is about 13%. That's better than expected. That's great. So 13% is what analysts were saying at the beginning of the year for earnings growth. That's now 10, so it's been downgraded to 10. And we're thinking that depending on how far this trade war goes here, if it doesn't get resolved real quickly, we could be looking at more like 5% earnings growth for the year. So not nearly as exciting, probably a little bit subpar if you look back in history. So what I wanted to say here is that the valuation reset is normal, but what we didn't want was this growth scare based on an open-ended trade war, because it will act as a tax on growth. That's not to say some of these other opportunities on the left won't come to fruition. The Fed is a proven hand. I think they've proven that they engineered a soft landing, got rid of excessive inflation in most areas of the market, and they seem to have a good head on their shoulders. I think the Fed will eventually step in to lower rates. It would help. I just don't know how long it'll take them to come to that conclusion. And then finally, you know what everybody asks me, hey, the Trump administration promised a carrot and a stick, but all we're getting is the stick. Where's the carrot? Well, deregulation and tax cuts should come later. One main area that I think that comes to fruition is with regard to banking regulation. You know, these Basel III banking regulations that we're really over the top. I think we're going to say goodbye to that forever, at least forever in the span of investments, which is a couple of years. We're going to say goodbye to that, and I think banks are actually going to be free to raise their dividends, maybe do some stock buybacks, which would really help. That's a sector that was overregulated to the point where it just, I mean, investors couldn't make money for a while in the financial sector, and I think that's going to turn around. So again, just because there's heightened risk doesn't mean there are no opportunities. Our base case then, looking at balancing those risks and opportunities, is that, you know, volatility is going to be with us for a while. This is not going to be solved overnight, but we need to avoid reacting to these political pronouncements that are so abrupt and so fluid. In other words, they can be easily reversed. You know, you can hear about a trade tariff being angrily pronounced in the morning, only to make it to afternoon and hear that there's a carve-out, a very important carve-out to that trade tariff that will exempt entire industries from that extra tax. You know, uncertainty is called that for a reason. You just don't know. So we're trying to avoid reacting to that. It looks like the economy is going to slow. Part of that is natural, moving back to normal. And even before these trade tariffs were announced, the economists felt like the economy was going to slow from 2.8% down to 2.3%. I'm saying that, you know, depending on how bad this tariff thing gets, it could go to 1.5 at the bottom, 2 to the upside. Importantly, that does avoid recession, meaning we're still growing, just like earnings in the third bullet point there. We're still growing, but just not as fast as we expected. And what that means is likely returns on the stock market will be more muted now, I think, we feel like than we did at the beginning of the year. So definitely not worst case scenario, but all of this, including uncertainty, as a tax on growth. I want to thank you for watching, and thank you for being clients of the firm. We really value our relationship with you, and I'll see you in about a month to 6 weeks. Thank you very much.